If you are an investor in US stocks, you might be having some sleepless nights as daily news on tariffs rock the markets down. The Dow Jones, Nasdaq, and S&P 500 are down by around 10% in just about 3 weeks. To make sense of this chaos, we have a very special guest, a Wall Street veteran of 35 years, Andy Constan, joining us in an exclusive interview to the Hindu Business Line. So I would like to keep this, split this interview into 3 parts. First would be the macro and market, where you can help all of us here make sense of what is happening, all the chaos, and what it means, because we are also facing ripple effects of what Trump does every day. Our markets do react. And then the second part would be, you have a terrific history. I mean, Salomon, then Bridgewater, then Brevan Howard, and then Bridgewater, and then your own funds, etc. So I would like to learn, like people can learn what was the experience, like what is the learning curve, etc. And the third part would be, you have so many decades of experience, and some little bit on what are the discipline and approaches that have helped you be successful in this space. So, so I thought I'll split it into these. Can I start with macro and markets first?
Sure.
Yeah. So, see, in FinTwit, you are today. Everybody is saying Trump wants, Besant wants lower stocks. His focus is on the bond yields. But from what I can recollect, because I follow Twitter extensively and FinTwit a lot, and you are among the earliest to say Scott Bessent wants lower stock prices. And since then, there has been a lot of chaos. I mean, markets have been down. Bond yields, I mean, bonds have also been up, and yields are down. For people here, it looks too chaotic. Can you help us understand what is happening and how this is going to play out actually for US markets, from which we can infer what's going to be the impact for global markets?
Sure. So I guess we have to rewind the clock to COVID and start with why US stocks in particular have broadly, and the US economy has broadly outperformed the global economy. And I think that is very clear. The United States was by far the biggest and by far the most aggressive, responded by far in the biggest way, and in the most responsive and the most sorry, it's early in the morning. The response of the United States during COVID was large. Both fiscal and monetary policies were extremely accommodative. And the result was a huge impact on the overall economy. Essentially, all wages that would have been lost, and in some countries were lost due to the COVID shutdowns, were replaced with government handouts.
Okay.
And so that fiscal stimulus, which also was absorbed by quantitative easing, large-scale asset purchases, created an environment where asset markets were supported by the economy was supported by that money printing, essentially money printing, fiscal spending that was monetized by bond purchases by the Fed. And that spending became savings, which also went into the market looking for assets to buy, and the Fed had already bought all those assets. So that created a very strong growth impulse and inflation impulse, obviously, as well. And there were certainly some transitory elements of it as it relates to supply chains and going back to work and pent-up demand and all those things. But the big impact was on nominal GDP in its entirety, which is the combination of real growth and inflation. And so since the COVID bottom, I've been very, very bullish on the US and GDP relative to itself and relative to the rest of the globe. So here we are. Inflation has been sticky. The Fed has panicked a couple of times, and the Biden administration has panicked a couple of times that the labor market was going to turn over. And market participants have been calling for a recession starting in mid 2022 through today.
Yeah.
And each of those times, the economy kept moving along. And the reason I think it is because income growth and jobs and wealth have supported the economy in this cycle, unlike in past cycles where private sector debt growth supported above trend growth and inflation. And so that's a very unique set of circumstances and requires a very different response by fiscal and monetary policymakers. And both of them have botched that response made by seeing slight turnover in data, which caused them to ease significantly in 2023 and in 2024. And so here we are, finally, a couple of things are starting to happen. The central bank, well, firstly, the central bank cut in September in a way that was not necessary. And immediately, because the economy was heating up, not cooling down, immediately long-term bond yields rose significantly, 100 basis points. Even two-year notes rose significantly because the expectation was that the Fed had cut too early. They ended up cutting twice more, and they got to a level they think is worthy of a pause. But what had happened was a tightening of financial conditions due to the rise in long-term bond yields. And so we entered January with long-term bond yields high, equity prices still high, and the Fed very clearly on pause. And that's where we are still by and large, but things have begun to move. And yet the economy remains fairly robust. Jobs are strong, job market is strong, not seeing any turnover yet. And the reason is incomes and wealth still remain robust. And so to cut demand, which slows growth and causes inflation to decline, the Fed needs to continue to pause. And I think they will. Those combinations of things led to my call that finally, after 5 years of optimism regarding the NGDP of the United States, that we were in for an actual slowdown in the second quarter, which has come along faster than even I expected. It was very out of consensus. It caused me to cover my bond short in January, and it caused me to get very short equities. Then you add, so we already have this tightening of financial conditions in terms of long-term bond yields and a pause by the Fed. Now you add on top of that the Trump administration agenda. And the Trump administration agenda starts with immigration because that's something they can do and have done. And when you slow immigration, well, let's step back. Part of the ability to grow in the United States during the last few years has been the very rapid increase in labor supply associated with immigration. And that has allowed a disinflationary pro-growth outcome. More workers, more output. And so the Trump agenda is to slow that growth or possibly reverse it, though I don't think that's realistic. Slow that growth. And that will create a inflationary anti-growth stimulus. And so that's happening. they also are attempting through the reconciliation bill, which is the primary spending and taxation action of the Trump agenda, to cut Medicaid, food stamps, and income assistance, which are all programs that aid the least fortunate among us. And in order to pass the extension of the corporate tax cuts and high and wealthy tax relief that was implemented in 2017, that sunsets at the end of this year. So that policy doesn't really change the tax flows associated with the wealthy or the corporates, so isn't stimulative in that way, but is very anti-growth when you take the bill has $1.5 to $2 trillion over 10 years of reduced spending, and that hits real people who can no longer consume. Okay, so that's policy 2. Policy 3 is Doge. And so that's nothing can happen with Doge until the budget process for 2026 starts. We're just dealing with the second thing was reconciliation, which really just deals with 2025 spending. 2026 spending will be the first time that the Trump administration is able to pass a budget. Presumably they will be, we don't know. And that could have Doge start cutting expenditures. Cutting expenditures, whether they're wasteful, fraudulent, fat, muscle, or bone. Doesn't matter which of those things. Obviously, no one wants waste, no one wants fraud, and if there's fat, it seems sensible to cut. No one wants it to not do those things, but the fact is all of those things are anti-growth and disinflationary. So that policy is anti-growth. The last policy is tariffs, and that's a more complicated one because there is lots of volatility around the implementation of tariffs, who they're targeting, how they're targeting, the legality of how they're being dealt with given existing treaties, et cetera. And so it's a mess. There's just no two ways around it that the administration says something like we're going to implement 25% tariffs and then shoots first and then aims later and realizes that when you do that to Mexico and Canada, you're violating the agreement that you personally signed in the US MCA, which is the North American Trade Agreement. And so there's some sloppiness, but that's not the point. The point is that Trump, for now, and for now, some people are doubting him and other people are taking him at his word. But for now, he appears to be interested in reshaping global trade with the goal of having more free trade, not less, and on the other hand, have it be advantageous to U.S. Production versus U.S. consumption and U.S. production versus rest of the world production. And so there's a transition when that happens and when the actual tariffs occur, because the tariffs impact consumption. They're literally designed to increase the share of domestic production at the direct cost of domestic consumption, GDP share. They don't grow or shrink the GDP necessarily, they just take one from the other. And so the consumption has been a big driver of the US economy, particularly government consumption, which is, as I said, slowing, but also individual consumption has been a big driver. And so that's anti-growth and pro-inflationary. So you take all 4 pieces of the Trump agenda, and short term, they are anti-growth and some are inflationary, some are disinflationary. And you add that up, and that's bad for stocks. And so the market has finally begun to move in that direction.
Okay. So the doubt I have is Trump has 4 years. Why this time they seem to be acting like there is no tomorrow to get their things done? Because if you go back to 2000, his earlier term, tariffs started in 2017, and which is almost 1 year after he took over, or early 2018, 1.5 years. This time, why can't they wait for the Fed to pause, let inflation settle down, let the economy adjust? The economy will be in a better shape to take the pain of these tariffs or wealth effect that they want to reduce and all that. Why is it going hand in glove with the Fed pause, which is also happening? So any thoughts on that, actually?
Well, the Fed certainly wants to cut demand. That their whole policy agenda has been to reduce demand on to kill inflation. And so they're all for an equity decline and all the anti-growth policies that the Trump administration is doing. Why is the Trump administration? So they are working. In my view, they are together in policy if the goal was to finally slay inflation. And so I think they're working well together in that way now, whereas the Biden administration was not necessarily working well together with the Fed, and a number of times did things that were like issuing a ton of bills instead of long-term bonds, were actually going in the opposite direction of the Fed. So I think the Fed and the Trump administration are aligned, and the outcome will be the death of inflation. The question is, why now? If I were, who knows, I'm not a political expert, but if I were in Trump's shoes, I certainly would rather have the pain be felt early in my administration. If your goal was to achieve the things his agenda is going to attempt to achieve, I would certainly rather take the pain early than late. And so, and also it's a political reality that when a new president is elected, they get to work fast.
Okay. So from that looks like maybe they have a plan, but is there, with so many things happening at the same time, right? Tariffs, inflation still not under control. There are geopolitical issues, China, Taiwan, Israel, etc. Is there a chance that while they may have a plan, things can get so out of hand and the markets might face a train wreck kind of a situation? Is that possible?
Well, I think you have to put some perspective on what's happening in markets. We're down 10-ish%, and yet that's nothing relative to where we've come from. The stock market's still in spectacular shape relative to where it was even before COVID. Corporations are generating what may be as high as 11% earnings growth next year, and was high last year, around the same. The economy is very strong, and if you're going to, you want to take profits on a strong economy. You don't want to cause pain when the economy is on its heels. You want to, when the economy is gangbusters, that's when policymakers should respond, and so they are.
Okay. So then the other doubt I have is, so earnings growth 10-11%. I saw the report also where you have highlighted how for the last few years and the next few years. But is there a possibility with deficit reduction, earnings can surprise significantly to the downside? Because I've seen theories, including John Hussman has given, and even Jeremy Grantham Mayo, they've written how there is a correlation between deficits and corporate earnings. Do you subscribe to that view? And if there is a cut, the government is on a clear path to cut deficits, can earnings shock, I wouldn't say shock, it's too strong a word, but disappoint investors?
Well, I think you first have to start with So I agree with that relationship between corporate profits and deficits by and large. I would say that what we're seeing is not necessarily going to cut the deficit much, because some of the spending plan, some of the tax relief that is already in the reconciliation bill and proposed as potential additional tax relief in Trump's agenda would mean that all of the DOGE and tariff revenue and reconciliation cuts to the poor might be completely offset by lower taxes. And if so, that would mean the deficit would stay relatively close to where it is. But the important factor is the expenditure cut, not the deficit. The deficit depends on whether you take money from people by charging them more or less taxes, or you take money from people, savers, who by demanding they buy your bonds. One way or the other, the deficit gets financed. What matters is the expenditure cuts, and the expenditure cuts are a fiscal tightening like we've not seen. If even conservative DOGE estimates are made, the hit to gross expenditures, which are roughly 7 trillion, could be as much as 500 billion. There's been numbers like a trillion, but 500 billion is a very aggressive number. You know, that's a 14% hit to government in the GDP identity, which says that GDP is government plus investment plus consumption plus net exports. A 14% hit when government is, roughly 20% of the economy is a major drag on GDP and will be a major drag on stock prices if it happens. But so we're also correcting for that now.
Okay, so it will be deficit expenditure cut impacting earnings, impacting stocks. Is that how it will play out? Okay, so
I would say it this way. Deficit cut impacting demand, in fact, impacting earnings, impacting stocks.
Got it. So then if this, you're saying this impact of this will come in the 26 budget, not in 25, is it? It's how does the budget
there's limited amount that can be done in 2025. It's only, for one, there's only 6 months left.
Okay, it's July to June. Okay.
Yeah, September 30th, actually. So we've got 6.5 months of the impact of reconciliation, which is going to be a small hit, but a hit nonetheless. It's really the expectations of the ongoing government portion of GDP that has yet to be adjusted for.
Okay, so this is how should people approach markets, because this Musk and Trump and Besant are saying this is what they're going to do. And of course, there are views like yours that it's difficult to do so much of cuts. So what should an investor, how should they play this?
Let me tell you what I think is the type of market that, firstly, what the type of market I like to see when I make investments. So I don't know. I can't predict future growth and inflation. So generally, I look for what I call Bridgewater, where I was trained, calls an all-weather portfolio. One that does well if growth disappoints, or growth does well if inflation disappoints, or inflation does well. What you need for that type of portfolio to do well is versus other portfolios, is you want your country to have low asset prices relative to the rest of the world, a central bank that is either accommodative or is likely to become accommodative, and a fiscal policy that is expansionary. Now, that may not sound great for bonds, but bonds will still do well in such environments because of the monetary easing and the pricing. And so that's what I look for in an economy. And so, for instance, the US has none of those things at the moment. It has a fiscal policy that's contractionary, a monetary policy that is more restrictive than it has been and likely to stay restrictive, and asset prices that are the highest amongst the developed world. And so what you get is this is not an attractive place to own assets. On the other hand, and each market is very different, but I'll just broad stroke this. On the other hand, Europe, as of just recently, which is a fascinating development, just recently they have decided, principally due to Trump and his policies of withdrawing the protective force of the United States, has caused the Germans to and the Europeans to consider allowing debt-financed expenditures on defense and infrastructure. And that's fiscal easing, and that's very bad for bonds initially, and they're repricing for that reason. But the repricing is the opportunity, and it's excellent for the economy and for assets in that region. Monetarily, because of the nature of the Eurozone, where Germany is now going to spend, but Italy may need, or the rest of the South may need still easier conditions, isn't likely to start hiking. So you've got a very attractive environment for assets. China, assets are very, very cheap and should be. And there is a fair amount of fiscal now being implemented and monetary easy. So that looks like a better asset market. And Japan has a fiscal authority that is neutral, but monetary is slowly getting less easy, but not intending to get very easy. And the economy is very strong. And so those, and bond prices have corrected. And so asset markets in Japan, Europe, and China look much more attractive than they have, and certainly relative to the US. And so I think what you're seeing, and you will continue to see, is global flows out of the US market into the rest of the world.
So which means the dollar should weaken, is it? Or?
Right, and it has been.
Okay, all right. So, is there, just one last question on this pure equities thing I wanted to ask you.
Yeah.
Before that, just one thing. Do you have any view on Indian equities? Have you followed it? Or?
I really don't. I think the one thing I would say is that so I don't deal with the emerging markets in general. The only emerging market, because it's now become less emerging, is China that I deal with. And I would say that there seems to be some willingness to, from the Trump administration, to lean toward India as a alternative to places that they want to lean away from.
Okay.
But I don't know what's priced or what's likely to occur.
Got it. So this final equity thing, so you've explained how to play a combination of assets. So I understand you don't predict market levels, right? You don't think whether we are in a bubble. You try to have a holistic portfolio looking at on a relative basis, right?
Right. So that's sort of my general investment philosophy, to look for asset markets the way I've described them and where I favor assets versus others. And it has that currency implication that you said. Then there's the predicting short-term moves in the next 1 to 3 months. And that's where I spend a lot of my time. It's not for everyone, and it's very hard to do. But right now we're in the midst of a slowdown, which I think will not be in a straight line. And it's very possible that you could see the slowdown reverse, or you could just see markets reverse. And if you were to, you could see equities in the US rally relative to everyone else. And so, but the trend is the way I've described, which is significant anti-growth policies and very high expectations for equities. And so I favor short equities, and I think every rally should be sold. On bonds,
Okay.
bonds in the United States are have the problem that they're priced fair for the Fed to cut somewhat, more so than what the Fed has said. And after today's CPI, which just hit, which was weak, you might expect them to cut more.
Okay.
But it's already priced that they're expected to cut. So it's not likely you're going to get much benefit from a cutting of interest rates in the United States on the short end of the yield curve. And on the long end, we still have a tremendous amount of debt to finance. And if we do get a slowdown, bonds will rally. But I guess the point is that they won't rally enough to protect you if you're long equities.
Okay.
So that combination makes cash very attractive to me at this stage.
By cash, you would mean 2-year treasury bills, is it? Or...
Something shorter, 2 years and shorter.
Okay.
On an unlevered basis.
Okay. All right. So, the thing about having a portfolio like this is you don't have to have a sleepless night like an equity manager. Like, is that correct? Actually, is that the all-weather portfolios? Like, if you're a pure equity fund manager, might be worrying about their portfolio, what is going to hit them the next day, or like we have this thing, what gives you sleepless nights?
Well, so I mean, a pure equity manager has to be benchmarked against equities, and so their job is to outperform equities or not.
Okay.
They can't do much. They can raise cash maybe, but they can't really do anything other than that. And they're not meant to. They're meant to pass on equity exposure to their clients. If they're an active manager, then they might, and this isn't my lane, but then they might choose to reallocate to certain stocks that would benefit from a slowdown or be hurt less from a slowdown. And there are lots of things they can do, but that's not really mine.
Would you have any sectors or suggestions for?
That's really not my lane.
Okay.
I don't focus on sectors.
Yeah, you're talking about financial conditions being restrictive. In your January report also, you had mentioned how it has increased. But with now the difference between the 2-year and the 10-year bond shrinking post this Doge scare, tariff scare, etc., have financial conditions eased, or do you think they're still tight actually?
Well, it's interesting. First, bond yields rose, and now they've come back a little bit, but they've come at the expense of equity prices. So while the narrow financial conditions associated with interest rates have come, by the way, they're still much tighter than they were last summer, but somewhat easier than they were a few weeks ago. At the same time, equities are a measure of financial conditions, and credit is a measure of financial conditions, and those things have tightened meaningfully. So in aggregate, conditions are still, financial conditions are tight.
Okay, all right, got it. So it's actually as tight as it was in Jan, because equity prices have fallen.
Roughly.
Got it, okay. And it's going to remain this way.
We'll see. The central bank could act in some way. The government could withdraw some of its anti-growth policies and stimulate. Oh, who knows?
Okay.
But at the moment, I would expect, based on the path that we're heading, financial conditions remain tight.
Okay. And recently, you had written in your Substack when Fed will intervene, 10-12% correction. So, what is the put of Trump administration for equities, bonds, and currency, home prices? Sorry, where do you think, what is the tolerance level?
I'm not really a believer in that concept.
Okay.
A lot of people like to use it. I think people rest on the assumption, which is proven to be correct over the years, that in a financial crisis, the central bank and the fiscal side will act. And 2023 in the banking crisis was a clear example of that. And I would expect it to happen again if we were to see financial stability concerns. But
Okay.
a stock price level doesn't matter at all. It could be right here if a bunch of banks blew up, and it could be 40% lower if not a single bank blew up.
Okay. Okay. It can be so that can be so much of tolerance also.
Who knows? It doesn't exist, is my point. There is no put.
You're saying it's contextual to a lot of things.
Right, and depends on a lot of things. But will happen if we have a financial problem. If we had a war, if we had another pandemic, if we had some sort of private sector leverage problem, all manner of things could happen. But that's always, there's no level that they're looking at.
That's the unknown thing that you refer to, right? The unknown risks. That's the unknown risk you refer to. In the
or unknown. Risks are, but it's not a stock market or bond market or currency market level, at least in my way of thinking.
Okay, got it. So you're coming back to the economy. You're saying that the economy is doing well, but you've also said economy is slowing down. It is you yourself expect a slowdown in the economy.
So this is the difference between looking in the rear view mirror and looking forward. Looking in the rear view mirror, the economy is doing fine. Looking forward, the financial conditions have significantly tightened in the last 6 months. The Fed is on pause, which is tight, and the fiscal is doing a tightening that we have not seen in our lifetimes. So looking forward, the economy is not going to be able to withstand that sort of thing, and there's going to be a likely meaningful slowdown.
Okay. By slowdown, you say referring to around 1.5% growth, right?
So far, it depends on what gets implemented. I don't like targets. What I like to think about is pressures, and the pressure is for weaker GDP.
So, weaker GDP
relative to expectations.
Expectation and positive real growth. Is that something you would say?
And possibly what?
Positive real growth, positive real GDP growth.
Well, real GDP growth is, listen, you could always have things like recessions, but I'm on a path, not looking at, I don't look for destinations, I look for paths.
So you're saying slow down, basically, just that we don't know whether.
Slow down with an unknown destination.
Unknown destination. So which can be much worse than expected, but you wouldn't expect a 2000.
Could be better or worse. There's lots of people out there who will tell you the world's going to end. I'm not one of them. I'm telling you the world is slowing down, and that's enough. You don't need a destination to. In fact, a destination is probably the worst thing in the world to have stuck in your head.
Yeah, like Galbraith said, forecasting exists to make astrology look respectable.
Right.
Good, great. Now we'll move on to your other. I've always been reading that post on Brady Commission. Your role was so fantastic, actually. So how old were you at that time, actually?
What's that?
How old were you at that time, actually, when you were
in the Brady Commission? That was in late '87, early '88. And so I was 23. I was 23 years old. Okay.
So how did you? So from there, you said that changed your career, right? You wanted to do an MBA or something, but you continued working.
Yeah, my 2 years as an investment banker out of college, I was a bioengineer, so I had many different career aspirations during my college years. But I decided to get a job on Wall Street. Most of my friends were going there, and so I went, and I enjoyed it, loved it. But the Brady Commission got me interested in markets and market mechanisms and how all these flows piece together, as well as trading and investing in general. And so that brought me down to the trading floor at Salomon Brothers, where I started as a convertible bond trader and just fell in love with the puzzle of markets.
Okay. And you've largely been an arbitrage trader, right? Through your derivatives desks and.
Well, I spent 17 years at Salomon Brothers, and my roles there were always quantitative trading oriented. When I left, I was global head of the global equity derivatives business at Salomon, which is about 600 people, $1 billion revenue type business, and really touched every aspect of arbitrage within equity space. And my first hedge fund, both of my hedge funds that I was part of, I was a portfolio manager doing equity arbitrage, equity derivatives arbitrage, convertible bond arbitrage, and things like that. But in 2009-10, I started at Bridgewater because I saw what relative value. I knew the guys at Long-Term Capital very well. They were ex-colleagues at Salomon Brothers. I saw over many years of my arbitrage career, I saw macro events causing arbitrage losses.
Okay.
And realized that arbitrage was really very exposed to macro. And so in 2010, I looked to macro as the place I wanted to really develop my experience. And so have been doing that ever since.
So this is about
little over 3 years at Bridgewater, which was great. A little over 4 years at Brevin Howard, and then since then with a couple of garden leaves in between, and then Damp Spring ever since.
Okay. All right. So the macro thing is about how to make a derivative strategy, arbitrage strategy, resilient to macro shocks. Is that what you're saying?
Right. So when you have an arbitrage strategy, one of the most important things that you need is an exit. And in order to exit an arbitrage, you need it to converge and somebody else to be able to take on your position. And your position is typically highly levered. So if somebody wants the next person to take on your position probably needs leverage. And so in every financial crisis, 94, 97, 98, 2001, 2004, 2008, which are all during my arbitrage careers, every arbitrageur lost money. Why?
Okay.
Because financial leverage had been pulled from the marketplace.
Okay.
And that's a macro thing, not a micro thing, not an arbitrage thing. And when that happens, there's no bid for your positions.
And I read a tweet of yours on Asian financial crisis and Jamie saying, can we sell that Hong Kong wall, right? I mean, so you'd written about the losses the company had because of the exits. I remember.
Right. That's always the case. There's something that drives a deleveraging, and a deleveraging in big asset markets creates a significant impact on arbitrage strategies. Right when the opportunity set tends to get very large, it also gets hard to put on new positions.
Got it. So one last question I have is, so obviously surviving Wall Street without blowing up itself is a success, actually. I mean, so how did you manage, the values, the discipline? Could you share something, like if somebody wants to be a trader, investor, something that you held on to that has been of real help?
I mean, my highest level advice for people generally is, if you're trying to manage your own personal money, you can't beat the market. And so you cannot beat the market. You can work day and night and you can't beat the market. And so you should invest broadly, in a diversified way, long only. In the event that you have some career that is taking you into trying to beat the market, or you desire to beat the market in a way that is probably unrealistic, the best thing I would say is find a firm that offers you a seat with someone who is, as your mentor, who is not only good at what they do, but also very good at providing and advancing your career. And that's very hard to find.
Okay.
But that's the idea. It also helps that that person is broader than their narrow investment philosophy, and that the firm you join has broader aspirations than the single thing you do. And so that's the sort of firm I'd look for. And then it's really about curiosity and work ethic for me. The person who is constantly asking questions, constantly assessing answers,
Okay.
and figuring out their own way with good help and good mentors is the person that I want to, that I try to be, and that I try to pay forward to others. All right, Harry.
So,
See you.
my pleasure. Take
Bye.
care. Good luck. Bye.